Hello, everyone. I'm Jody Schneider, president of the FCC and senior international editor at Bloomberg. And I'm here to welcome you to our FCC lunch talk. First, I want to thank the staff on kind of a day's notice. They went from configuration of 4 tables to configuration of 2 tables, and I think it worked. We're still able to do these, so we're very pleased to be able to do this even with distancing measures and all that. Before I introduce you to our speaker and our conversation, I wanted to tell you about a few upcoming events. We're still having events, even though it's December. We will have a book talk next week. Michael Schumann will be talking about Superpower Interrupted, the Chinese History of the World. It will be moderated by our FCC correspondent member, Governor Keith Richburg, who's here. That will be next Tuesday, the 8th at lunchtime. It may already be sold out, but get yourself on a waiting list if you can. And then we have 2 Zoom events, 2 really terrific Zoom events, kind of back to back in terms of days. Next Wednesday, December 9th at 7 p.m. at Hong Kong time, I will be moderating a conversation with Michael Palin, of Monty Python fame. So we're very excited about that. And there's no waiting list for that. Just sign up, and we will we run all these on YouTube afterward, but it's really fun to be able to watch them in real time. And then the next day, Thursday, December 10th, we will be talking with Alan Rushberger, formerly the Guardian editor, who is going to be discussing his new book, News and How to Use It, What to Believe in a Fake News World. He'll be in conversation with our FCC First Vice President, Eric Wishart. So lots of things coming up. But to the main event today, Money Games, the inside story of an iconic Asian deal. We're very pleased to have with us Weijian Shan, who's our speaker and a conversationalist with FCC correspondent Governor Jennifer Hughes of Reuters. And he's going to be talking about a book that is for sale over there called Money Games. And it is the inside story of the takeover of what was once Korea's largest bank by an American private equity firm. And he's going to tell us all the details about how it happened, which he does in the book. And we welcome questions at the end. If you are going to ask a question, we ask that you put a mask on. Microphones will come around, and that you also identify yourself and your affiliation. So a little bit about our speaker. He's chairman and CEO of PAG, a leading Asian private equity firm. He was a partner at the private equity firm TPG and co-managing partner at TPG Asia, which was Newbridge Capital, a managing director at JP Morgan, professor at the Wharton School of Economics at the University of Pennsylvania. He has an MA and PhD from the University of California, Berkeley, and an MBA from the University of San Francisco. Besides the book we're going to talk about today, he is also author of Out of Gobi, My Story of China and America, which he discussed with us last year here, and that book is also for sale over there. So with that, I give you our speaker, and Jennifer Hughes from the FCC. Thank you.
Thank you. I like that we're going from effectively comedy royalty, mentioning Michael Palin, to journalism royalty with Alan Rusbridger, and now we have Asia private equity royalty in the case of having Shan here. Shan, thank you for doing this. And by the way, when we were talking there, Shan said he'd be open to talking about anything he feels he has some knowledge of, so please prepare some questions.
Anything I know.
Okay, anything he knows about, yes. Is the microphone working well? Can you tell us? The mic is not working, guys. Okay, I'm not going to spend time summarizing the book, but while we're trying to fix this, it sounds like it works. Okay. Shan, I'll give you a chance to, we don't want to go into too much detail in the book, because you want people to buy the book at the end of this lunch as well. But please, could you just sort of summarize the deal, what happened, and what for you were the important takeaways from it? And another question from me on this, how on earth did you keep your patience and keep focused on the deal with so many changes and so many setbacks the negotiations?
At that time. There were more distractions today than at that time. Not quite sure if this works well.
I'm sorry, there's an echo. Would it be easier if Shan switched to the handheld for now?
Sorry about that. The book Money Games is a story, inside story, of a major private equity deal which involves an American private equity firm acquiring what used to be the largest bank in Korea, which failed during the last Asian financial crisis, and it was nationalized by the government. And it was an extraordinary time, and I'm sure many of you have read the book Barbarians at the Gate, which is also a story about a private equity transaction. And it was KKR's acquisition of RJR Nabisco in 1988. At that time, it was the largest ever private equity transaction in history, involving 25 billion US dollars. The book became a bestseller. It was made into HBO movie, which also became very popular. But the book, like other books on private equity, dealt only with the deal-making part of that transaction. The book was written in 1989, 1 year after the deal was put together. Very few people know that, in fact, KKR stayed invested in that business for about 15 years. And after 15 years, they lost money from the transaction. Of the $25 billion, 22 was borrowed from banks, and $3 billion equity was put into the transaction, and they lost, oh, this is much better. They lost a total of $750 million from that transaction. Henry Kravis of KKR likes to say, he often says this, any idiot can buy a business. It is what happens to the business afterwards that really matters. To date, to my knowledge, there's no other book talking about a private equity deal from beginning to the end. That is what happens afterwards, especially how you got out of your investment. And my book, unlike any other, I suppose, covers the entire investment cycle of that major transaction, which was very significant for Korea because it was part of the banking restructuring in Korea after the financial crisis. And the book covers from investments all the way to turnaround of the bank and then to the eventual exit from that bank. And I think for anybody interested in private equity, it will be interesting read because private equity has become very significant. In the United States, there are more companies controlled by private equity firms than publicly listed companies. You know, I don't think that's well-known knowledge. So that's how significant private equity has become. However, even though private equity is very much talked about, it is very little understood. It remains a mystery. Some think that private equity is a destructive force. Some think that private equity is a force for good. And I think my story would at least shed some light on the inner workings of private equity. And I also think that the time is little similar when this deal was taking place to what we're experiencing today. In Asia financial crisis in 97, 98, the market was in total turmoil here in Asia. Just to give you some idea, for those of you who are not familiar with what happened in Asia at that time, some of you have lived through it. In 1997, on October 23rd, of that year, Hang Seng Index dropped 16% on that day. In one day, the stock market dropped 16%. By December of that year, South Korea's stock market dropped 49%. Half of the value was wiped out. And that's not the worst part of it. The currency, Korean won, lost 65.9% of its value against the US dollar in that year. The foreign exchange reserves of the country dropped to $8.9 billion. Now, Korea is the 10th largest OECD, or largest economy in the world. It was a member of OECD. It is the 10th largest today. It was 10th largest at that time. For such a large economy to have only $8.9 billion in foreign exchange reserves left to meet with its foreign borrowing obligations was a huge crisis. My firm, PAG, of which I'm chairman and CEO, we manage $40 billion. And Korea as a country had less than $9 billion left in its coffers. That was when IMF came in with a rescue package, also the largest ever in history, $58 billion, with the condition that Korea had to sell one of the failed nationalized banks to foreign investors for a simple reason: credit culture was lacking. The real banking practice was lacking in Korea. It had to be brought in from outside. So that was the background against which the story took place.
That's a pretty good summary of the Asian financial crisis right there. You'd almost think you used to be a professor, Shan. So thank
Yes.
you for that. Just on the deal itself, one of the things that really struck me, because you had so much detail and you could say that we came up with this proposal, but then the goalposts kept changing, it seemed. How did you keep focused on doing this deal, and did you ever think that it was just too much trouble? This took more than a year of your life.
More than that, of course. After the investment was made, it took us 5 years to turn around the bank. Eventually, we sold the bank. Well, I suppose for any transaction, if it's complex, it takes time. But that one took much longer. I wouldn't tell you how much time it took. Otherwise, you may get bored before you read the book. But it was a very difficult decision for every term for the Korean government. See, the government was in crisis. The economy was in crisis. It was the worst economic crisis and financial crisis since after the war, Korean War, for Korea. And the country felt very humiliated when IMF forced it to open its door to foreign investment, to sell control of what used to be the largest bank in Korea. At the end of 1997, Korean government encouraged citizens to sell their jewelry, their gold, in order to replenish the coffers of foreign exchange reserves. That was how desperate the situation was. To bail out the failed banks, 150 banks in Korea failed in 97, 98. To bail out those banks, the government used trillions of won, Korean won, or billions of US dollars. Those are all taxpayers' money. So the government had the responsibility to get the best possible deal from the foreign investor. And the government, of course, was not experienced in doing this. They had never done this before. So every step on the way, they were afraid that they would make a mistake because they were dealing with some sophisticated financial investors. So they were afraid that we would be making too much money and they would lose on behalf of the government as well as taxpayers. So even though the negotiation was very hard, my sympathy was very much with them, knowing that they were responsible for taxpayers. And it was very difficult for us to build the trust because they didn't know what we were doing, whether or not we would make tons of money. out of the situation in Korea. So eventually I did something extraordinary, which is something that I learned in Hong Kong when I came to this city almost 30 years ago, 27 years ago by now. I offered a full refund policy to the Korean government side. I said, if I propose something, I'm obligated by it. I will not backtrack. If you agree to something and later you change your mind, you're allowed to do so. In case you think that I took advantage of you, I offer something that's not in your interest. How did I learn that idea? When I was in the United States, our family used to live in the United States. Every holiday, like around this time, Christmas, I would buy some gift for my wife. Usually, whatever I buy for her is not the right kind. she will not like it. And she will go back to the shop and get a refund or replacement, right? And 27 years ago, we came to Hong Kong. To my surprise, in Hong Kong, the policy in general is no refund. And therefore, I have stopped buying gifts for my wife ever since for 27 years because I don't want to be blamed for wasting money. So if you don't have this refund policy, then you will be reluctant to accept a deal. And I thought in Korea, as I was negotiating, if I offer the refund policy, like the common practice in the United States, then they will not hesitate to move forward. And if they make a mistake, they can come back. On at least 2 occasions that happened. On one of the occasions, I made a mistake, which involves a term that would be too favorable to us. So I went back to them and said, we made a mistake, and we take it back, and we amend the term in your favor. That's how you build the trust. And it was a long process to do so. Of course, as you know, in human interactions, it always takes a long time to build a relationship, but you will have to think from the point of view of the other side.
Thank you. That comes across very clearly in the book, and it's another reason I fully recommend it.
It could be frustrating at the time, but in retrospect, I fully understood what they were doing.
Well, I had to say the book gave me a greater appreciation of the ins and outs of deal making. It's more complex than perhaps I think people realize. I mean, but let's talk about private equity more generally. Back then, we were 10 years on from Barbarians at the Gate, which indeed is a great book, another one I'd recommend to people. But private equity was still at its infancy in Asia, generally. This would be one of the first deals by a foreign, it was the first takeover by a foreign firm of a Korean bank, but it must have been one of the first private equity deals in Korea, full stop. Since then, the industry around Asia has grown. There'll be more than 100 billion of deals have been done this year around the region. How has private equity changed over that time, and how has acceptance of it changed? Because as you said, this is an industry that had barbarians at the gate. Private equity was called asset strippers. There was quite a lot of suspicion.
Yes. Back then, about 20 years ago, there were very few private equity players in Asia. In fact, when the government of Korea decided to sell the 2 banks, they engaged Morgan Stanley to be the sell-side advisor. Morgan Stanley sent out 40 invitations to financial institutions, mostly banks, like HSBC, Citibank, and others, and some financial investors. There were not many financial investors, like Newbridge Capital, where I was working. And out of the 40, only 2 players showed up, Newbridge Capital, my firm, and HSBC. So there were very few private equity firms, and there were very few large transactions. Transactions for private equity typically ranged from $20 to $30 million, $20 to $50 million, no more than that. It was then. And of course, Korea at that time, in terms of economic size, was about the same as China And China is about the same as Southeast Asia. Today is completely different. From 1990 to 2019, in 30 years, the Chinese economy has grown by 36 times. And I still remember at that time, Japan was 4 times the size of China. And that is, Chinese economic size is a quarter of Japan. Now, of course, China is 3 times that of Japan. So the market has changed drastically. At the time, we thought Southeast Asia was too small because the total size was that of South Korea. And China was too small. And in the financial crisis, asset prices collapsed all over Asia, but China, because China was under capital control. There was no capital flight. So that economy didn't collapse, as did Korea, Japan, Southeast Asia, Indonesia, and other countries. And there were very few players, and we could pick our targets to invest. Today, oh, by the way, Newbridge Capital, when I first joined, was a $100 million fund. When we invested in Korea First Bank, it was $400 million fund, and that was the size. Today, my firm manages $40 billion, and you have funds, $10 billion or $6-7 billion. So the amount of capital available today is much larger, but the market has also become much larger. Take China, for example. Before, 10 years ago, you would have to struggle to find the investment opportunity to allow you to invest $100 million. Today, we don't invest in any deal that's less than $100 million. We invested in a company. It was called CMC, China Music Corporation, about 5-6 years ago. It is Spotify of China. And we put in about $100 million to own about half of the company. 5 years later, it went public under the name of Tencent Music Corporation, as we merged with Tencent Music. And now the market cap is about anywhere between $25 to $30 billion. I have not checked the stock market price. But the company has 800 million unique monthly subscribers, 800 million customers. Where on earth do you find so many customers for one single company? And that's how large scale that companies have become. That's why you can actually spend billions of dollars to buy companies. So the market is much larger. Of course, it's much more competitive. We're just talking about India take private that we did back in 2017. That was a $1.5 billion deal here in Hong Kong Stock Exchange.
That was a deal that I had followed closely, so it's one that I'd asked Shan about there. Shan, I wanted to ask about the motivation for private equity, because you say in the book, and I'm going to quote you here, "If I'm honest, putting bread on the table wasn't my motivation. I was driven by the thrill of this opportunity and beating our rivals. It was all-consuming. I could barely focus on anything else." Is that still how you get about deals? Is that what you need for private equity?
I wouldn't say that's the case for all private equity investors. I think many people are motivated by money. But in my particular case, I just enjoy doing deals. Yes, I'm still very motivated every day to do deals, because every day you look at a different market, you look at a different industry, you look at different business, and you feel the pulse of the economy in different markets, whether it's Japan, China, Korea, Australia, Southeast Asia, or India. So it's a lot of fun. It's interesting. It's continuous learning process. My life is a process of learning, and if this business gives me the opportunity to learn, to continue to learn, it's just very interesting. That's what motivates me. But of course, we have a strong fiduciary duty to our LPs, limited partners, or investors, to make money for them. Otherwise, we will not be able to stay in business.
That's a very good point. It's about time that I open to questions. So if anybody does have questions, would you raise your hand and we'll bring the microphone over. We have a question over here. And if you could say your name and who you work for.
Hi, Shan. Thank you very much. My name is Fred Yin. I work for Goldman Sachs, actually. So, question about, your comment on the, the size of the private equity market growing tremendously in Asia, and particularly for the rest of the world as well. There's a lot of capital in there. Do you see that there still is a point for, say, the publicly trading market if a lot of investors could simply get, exposure into these private deals? Like what is the value of a publicly traded market? For example, what do you think about that?
I suppose so, although I really don't think private equity is for retail investors, because we have been quite successful in our investment, and that's why we have grown quite a lot, and LPs or investors have trusted their money with us. But private equity especially, there are different types of private equity. Buyout firms, growth capital, that is investing for minority positions, venture capital, which is highly risky. You invest in startup companies, some work out, some don't work out. So it's by and large a high-risk business. Our LPs are generally institutional investors, state pension funds, sovereign wealth funds, large insurance companies, which are very sophisticated. They know the risk, they are willing to take the risk, and they trust their money with us. For retail investors, I think if you make money, everything is fine. If you lose money, then it will be very difficult to answer to your investors who are not so sophisticated. So I think in the United States, some private equity firms have raised capital from retail investors. Some have raised capital from wealthy individuals through investment banks. But I really don't think that this is a game played by retail investors. However, Temasek has made a difference in this regard. Temasek
The Singapore Wealth Fund.
has created a very interesting model. They have invested in many private equity firms, and they have aggregated all their holdings, and then against their holdings, it's like securitization process. They sold units, almost like fixed income units, to retail investors, Singaporeans only, Singapore citizens only, so that they can participate in the benefits of private equity business without taking much risks. And Temasek will be the sponsor for whatever fixed income instruments that they issue to retail investors. I think that's a very good model.
Another question at the back there, right at the back. And just remember, if you do want to ask a question, please put your mask on.
Hello. Yeah, hi. My name is Suhas. I used to write for the Asian Venture Capital Journal. Back when I was covering private equity, right, I was consistently hearing from private equity professionals that there was a middle market gap. Like there are always all these venture capital and early stage investors, and then there are the ones who are investing in mature assets. But there was always a middle market gap that no one was willing to support and give growth capital in the middle. Do you still think that that's a problem? Was that a problem back in the day when you were involved with Newbridge and PAG? And can anything be done, or is this just systemic of Asia as a whole?
I never thought that's a problem. I mean, you have buyout firms, you have growth capital investments, you have venture capital firms. They meet different needs. For example, we don't invest for buyout firm less than $100 million per deal, but there are companies which want to raise capital less than $100 million. So we set up a growth fund which would invest anywhere between $20 to $60 million. The difference is for buyout, typically you buy control of the company. Typically, you make money by improving the operation of the company, you add value to the business, and then you exit. For growth fund, you by and large take a right. The company needs capital to grow, and you make an investment as minority investor, and you don't have control. So it's a very different business model. For venture capital, it's even more different. It's at the startup stage, typically even pre-revenue and certainly pre-profit. So you take a lot of risks, but if things work out, you can reap 10, 20 times return. For buyout firm or for buyout funds that we have, you can't afford to lose money for one single deal. If you put in $500 million, if you lose that deal, then your fund, your large part of it is wiped out and your existence is threatened. But for venture capital, you invest in 10 firms. It's called spray and pray. You invest in 10 firms, and maybe 5 don't work out, but maybe one of them is a home run, 100 times return, which covers all the losses. So the name of the game is to spray and then hope some of them become home runs. So it's a very different business model. But they meet different market needs.
Another question? Or I have one. There is another question? Sorry, didn't see you there.
Okay, great. Shan, thank you very much. This book is a very entertaining read, and it also sort of is a great study in what it takes to negotiate with the Korean government, or with officials from different parts of the Korean government. I actually have 2 questions for you. The first one is that you have quarterbacked 2 very successful investments in financial institutions and actually banks. And some of your competitors have made money in financial institutions, but there are others, who have lost the 500 million that you just talked about. So one question to you is, when you think about the future success of a financial institution's PE deal, and there was something you obviously liked about this, you and Newbridge obviously liked about this deal that kept you on it for 15 months. So, I'd be curious to get your views on what you look for, when you look at a bank type investment. Second question is a little bit more lighthearted. Given your experience negotiating with Korean government officials, what would your advice be to President Biden or anyone else who tries to take on Kim Jong-un?
Well, the first question, what do you look for? Obviously, in a financial crisis, what we're concerned is further downside, because you don't know when the economy will recover. So you want to make sure that you don't take too much risks. For a bank deal, if you control a bank, if you make new loans, obviously you're responsible for the risks of those new loans. If one of them goes bad, it's your responsibility. But we were buying a failed bank, so we wanted to make sure that we don't take the risks of what we call the legacy loans, because we don't know if the borrower was creditworthy. We don't know if the loan was substandard or it was a bad loan. So we wanted to make sure that the government was responsible for all the legacy loans, and we would be responsible for the new loans. So that was a major contentious point, because the government, of course, wanted to pass the risk to the investors. And in the financial crisis, I think that's the kind of a risk that we could not take, because typically at that time, now things have changed, capital represents about 5% of the total assets of a bank. So if you have a bad loan ratio of more than 5%, then your capital is likely to be wiped out, assuming that 5% all goes bad. For that particular bank we were looking at, in 1997-98, the bad loan ratio was 30%, and that was an understatement. So you knew that unless somebody took the risk of those bad loans, you will not be able to do the deal, because however much money that you put in, the government has already put in billions of dollars to bail it out. However money you put in could be wiped out if you don't make sure that you don't take the risk of the legacy loans. And then you will have to underwrite economic recovery, because investing in the bank is a bet on the macroeconomy. If you don't think that the macroeconomy is going to perform, to recover, and to grow, you wouldn't invest in the bank. Today, the situation is completely different. Today, banks are just too expensive to own because the capital ratio has increased so much, from probably about 5% to more than 10% today. But the lessons from the financial crisis really help all these different countries. For example, we know that so many banks failed in Asia in 97, 98. In Korea, in Japan, long-term credit bank, now it's a Shinsei Bank. Nippon Credit Bank, now it's Arizora Bank. In Indonesia, all over Asia, many banks failed. Fast forward 10 years to 2008, global financial crisis, so-called global financial crisis, which started from the United States with the collapse of Lehman, Bear Stearns, Merrill Lynch, all this AIG, even Morgan Stanley and Goldman Sachs were running out of capital. All the banks were in trouble. In Europe, many banks failed as well. But in Asia, none of the banks failed in 2008. Why is that the case? Because they all learned a lesson from 1997, 98 financial crisis, recapitalized themselves, improved the risk management system, increased the reserves for bad loans. So come the global financial crisis, all the Asian banks were healthy and resilient. So they weathered the financial crisis of 2008 very well. Now, you fast forward another 10 years to today, from 2008, 2009, global financial crisis. Any of the banks got into trouble in the United States, in Europe? No, none of them, almost none of them. Why? Because they all learned lesson from 2008, 2009 financial crisis. They recapitalized themselves, improved management, risk management, increased reserve ratios, enhanced compliances. So now they're very resilient. In fact, they're making record profit. So that's the lessons that we learned from financial crisis. What we look for is to what extent you take risks. So that's your first question. Regarding Biden and Kim Jong-un, I could only say good luck.
That's a very good diplomatic answer. We have a question over here.
Thank you. Hi. Despite increased U.S.-China tensions, lots of Chinese companies still going public in the U.S. Are SPACs on your radar as an exit strategy for Asian sponsor-backed companies? Would you guys ever consider sponsoring your own SPAC? Thank you.
Many people came to us to pitch for us to do SPACs.
Sorry, Shan, I'll just interrupt, and we should explain what a SPAC is.
SPAC is what? Special purpose acquisition vehicle. So there's such a vehicle that on the stock exchange, somebody like myself could simply raise a lot of capital without, for this SPAC, for this vehicle, without any assets, with a stated purpose to acquire some companies. So you can raise $1 billion without anything, and you can be a 20% shareholder of this SPAC with $1 billion with a stated purpose to buy other assets. I think it's not such a good thing for retail investors, because you don't really know what you buy into. You trust the sponsor of the SPAC to make money for you, and there are certain safeguards against the sponsors just walk away with your money. But for us, we have enough capital we have more capital than we can invest fast enough, and therefore it's not necessary for us to buy or to form a SPAC. I also think that it's not a good idea to invest in a SPAC without knowing what business the sponsor is going to buy, without knowing what price that he's going to pay, without knowing whether or not the SPAC will make money. But there's just a glut of capital in the world market today, and investors are desperate to invest in opportunities which they think they can make money, and therefore there has been a flood of SPACs in the marketplace. I think it's a bad thing. In fact, I think the stock exchange should ban SPACs.
Okay, we're running out of time, so I'm tempted to do one last question. We have one at the back there.
Sorry, I had to get my mask on. Sean, I have your book. I haven't read it yet. Now
Thank
I'm
you
very
so much.
excited to do so. But I have a question to you both as an economist and on the post-deal side of the transaction. In other words, what happened after. In 1998, during the Asian financial crisis, the IMF sent a team of 6 people with only one of whom had any expertise in East Asia, applied a pretty classic structural adjustment sort of philosophy to the loans, and the Korean economy collapsed. Koreans called the crisis the IMF crisis. They're very angry about it, but resilient, carried through. Do you think the IMF was right in the end to conduct that kind of large-scale restructuring to the economy?
Thank you very much for that question. I think there's a lot of criticism against IMF and the World Bank in their approach, and typically the criticism is centered around the so-called austerity programs, asking the countries in crisis to tighten their belt, to cut their budget in the middle of a crisis. As we know, last year or this year, the U.S. Congress unleashed a huge stimulus package. So it's the opposite of tightening your belt. But for a long time, IMF's prescription to Greece, to some other countries, was to tighten the belt in the middle of crisis. Arguably, that worsened the economic situation, just as stimulus was required. In the case of Korea, that was not the prescription of the IMF. They have not come to that particular point. The crisis happened already before IMF was involved. Yes, the Koreans felt a lot of pain during that period of time, and they were not happy with some of the conditions, but the most severe condition was to force Korean government to sell the failed banks to foreign investors. Again, in the belief that foreign investors would bring in the necessary best practices and credit culture to help restructure the banking system. I remember when I arrived in Korea in 1998 to do the bank deal, you get into an elevator, the close button is marked IMF. So people just keep pushing it, to vent their frustration with IMF. But that was not IMF's policy to impose austerity on the Korean government. Instead, IMF provided $58 billion and said, you will have to sell 2 banks, and that was about it. And in fact, eventually the Korean government only sold 1 bank to us, and the deal that they were negotiating with HSBC failed. Now, today, I think there's almost consensus that in the economic crisis, you will have to stimulate the economy, you will have to stimulate the demand, you will have to support SMEs or small businesses in order for the economy to get back on track. And that's what United States is doing, that's or we're coming to the end of the stimulus package, maybe there will be new one. That's what Europe is doing. And China is doing much less this year, to my great surprise. But of course, the Chinese economy is recovering very strongly, so they probably don't need as much stimulus as in some other countries.
I could keep asking questions, but I'm aware that people want to buy books and probably talk to you and get you to sign them. So I will finish this here and just need to say thank you, Shan, so much for spending the time. We really appreciate it. I could have asked twice as many questions, and I'm sure the audience could too. But thank you for your time. It's been great.
Well, thank you very much. Thank you very much. I have 3 books over there. I have Money Games, and my first book, Out of the Gobi, is also there. And that has a foreword written by Janet Yellen, the new nominee for the Treasury Secretary. She was my professor, my academic advisor when I was doing my PhD. So she very kindly last year wrote a foreword for the book. So if you don't read the book, read her foreword. You should get the book. But I also have a Chinese version of Out of the Gobi, which I rewrote, not so much from the basis of the English version. In any case, I have 3 books available over there. Thank you so very much. I feel so honored to be here.
And thank you, Shan. It's just for me to give you this gift here from the FCC. Thank you.
Thank you so much.